Hello, everyone. This is Blago, CEO and founder of Modelix, a business planning and financial reporting software for startups and SMEs. Today, we're going to create a financial model for a hotel or for any renting business within 30 minutes with Modelix. This is a professional, driver-based financial model that you can use to manage your business or to raise funds if you need so. So, without further ado, let's jump into Modelix and create the financial model. This is Modelix. To create our financial model for our hotel, we would have to go through these 8 sections here within Modelix. Provide our or define our revenue assumptions, cost of goods sold, employee assumptions, expenses, assets, financing, taxes, and working capital. And once we have gone through these sections, we would have our financial plan or our financial model done automatically by Modelix. And what a financial plan is, these are the 3 most important financial statements for any business. And this is the profit and loss statement, your balance sheet, and your cash flow statement. You can look at them on annual basis, or for the first year, you can look at them on a monthly basis. So let's start with our revenue assumptions. Now, before we jump into the revenue assumptions, what I'm using here in Modelix is the financial model template for a hotel. The first time you log in into Modelix, Modelix will ask you which industry is your business in, and whether you want to start with a predefined financial model for your industry. So this is the financial model for a hotel. So let's start with our revenue assumptions. A hotel, or at least a small hotel, would usually have two types of revenue streams. One is going to be your room revenue, and second is going to be your food and beverage revenue. You might have other revenue streams which you can easily add in Modelix by clicking here the Add Revenue Stream button, and then define your additional revenue streams. But for the purpose of this demo, we're gonna stick to these 2 revenue streams: rooms revenue and a food and beverage revenue. Now, rooms revenue. To calculate our rooms revenue for a hotel, we will base it on 3 specific variables which are relevant to the hotel business, and that is the number of rooms that we have available in our property, the occupancy rate per month and per year, and then the working number of days of the property within each period, and then the average room rate that we charge for renting our rooms. So let's say that our hotel has about 30 rooms, and this will not change over time. So we'll just copy paste this number of rooms till the end of the forecasting period. Then the occupancy rate. Occupancy rate changes differs usually over months. There is seasonality in the hotel industry. So, for example, if you're a beach type of property, the summer months you would have the highest occupancy, while in the winter you have a lower occupancy. If you're a ski chalet, in the winter you would have higher occupancy. In the summer months you have a lower occupancy. So based on your specific business, you define your occupancy rates for each month of the year. So let's say that we're a beach property, so we can expect an occupancy rate during the winter months of about 30%. Let's say January, February, March. Then in April, we expect this to increase to about 40%. April, May, and June. Then summer months, we'll say we'll have an occupancy rate of about 90%. This is the busy season up until August. September goes down back to 60%, and then October, November, and December, let's say we're gonna be at about 30% occupancy again. For the first year, we define the occupancy rates on a monthly basis. For the other 2 years of our financial plan, we would define them on annual level. So let's say we have an average occupancy of about 60% per year. Now, working days. Let's imagine that we're open every day of the month. So we'll just put the number of months as the number of working days in each month. Average room rates. Let's say the average room rates again in the winter months, they're going to be about $100 per room per night. Then it increases to $120. Then in the summer months, we are able to charge $180 average room rate. And then in the winter months, we are able to again to charge about $120. And then on an annual level for the other two years, let's say that we expect to charge $150 and $160 with per year per room night. With that, we have defined all our assumptions for our room revenue, and our room revenue has been calculated on a monthly and then annual basis. That's it. That's our room revenue. We start with the 27,000 or almost 28,000 in January. In the peak months, we are able to generate about 150,000. And then on annual levels, we are 700,000, 900,000, and a million in the last year of our financial plan. Now, let's move on to our food and beverage revenue. Now, the way we're going to calculate the food and beverage revenue is going to be the number of F&B or food and beverage bills that we have in every period of time multiplied by the average price per bill. Now, to calculate the number of F&B bills, we are going to use a formula where we're going to calculate the number of F&B bills based on the total number of room nights that we have in our hotel, which was already calculated when we were calculating the room revenue, multiplied by the percent of multiplied by the F&B bills as a percent of room nights. So let's imagine that every person that is in the hotel has at least one bill. It's one time per day in the restaurant. So let's say that 100% of our guests or our room nights are going to also become going to generate a F&B bill. So with those two assumptions, we have calculated the number of F&B bills in our restaurant. And the average price per bill is going to be $50. And let's assume that this doesn't change over time. So we're just going to copy paste that number all the way to the end. So with that, now we have calculated the food and beverage revenue and the total revenues for our hotel. And that's it. We're done with the revenue section. Now, let's move into cost of goods sold. The cost of goods sold are the direct expenses or the direct costs connected to providing the services in our hotel. So usually a hotel would have the following direct costs. It would have housekeeping supplies costs. It will have F&B costs. It will have commissions when we are getting a booking through booking.com or any third-party booking platform. We'll have credit card processing fees for those clients paying by credit card, and then we would have guest amenities cost. So let's go one by one. Housekeeping supplies. Usually the housekeeping supplies depend will vary based on the number of room nights that we have in our hotel. Now, the total number of room nights we already had calculated when we calculate our revenue. So the only input that we need to put in is the housekeeping cost per room. And let's say that this is going to be about $5 per room night. Now, with that, we've calculated our housekeeping supplies. That's it. We move on to the F&B cost. F&B cost, the best way to calculate the F&B cost is usually as a percentage of the F&B revenue. So usually in a hotel, you would have about 30% of your F&B revenue would be direct costs for the food that we're selling to our customers. So that's it. Put in the 30%. We don't expect that to change over time. So we have calculated our F&B costs. Next is our commissions. Again, these are the commissions that we pay to booking.com, Airbnb, or whatever third-party booking platform that we're using. Now, this is best calculated as a percentage of the total room revenue. So let's say that about 10% of our room revenue would be paid to third-party booking platforms. And again, let's say that this doesn't change over time for this demo, but you could, if you want to have different assumptions over time, of course, you can input that in Modex. And let's do that here for the commissions revenue. Let's say for the first year, it's going to be 10% of our room revenue, but then we expect to sell more through our own channels so that we can reduce this cost. And let's say that in the second year, only 9% of the room revenue will go into commissions. And in the last year, or in 2026, we would have 8% of our room revenue paid to third-party booking platforms. That's it. Our commissions cost has been calculated. credit card processing fees. Let's assume that about 1% of our total revenue is going to be paid for commission credit card processing fees, and let's assume that this doesn't change. And finally, guest amenities. Our guest amenities per room per day, this is going to be, or per room night per day, is going to be, let's say, around $2 per room night. And with that, we have calculated our total direct cost, or our cost of goods sold for our hotel. Next, we can move on to our employees. Now, depending on the size of your hotel, you would have larger hotels would have more types of employees, small hotels would have less, obviously. Here in the template, we have some standard types of employees for a mid-sized hotel. So if you're a smaller property, just delete those types of employees that are not relevant to you. If you're a larger hotel, just add any additional employee types that you have within your business. And you can add and delete easily. You can click just add employees, define what is the employee type, just follow the process. You can add as many employee types as you want. If you want to delete any of these, let's say you don't have a concierge in your hotel, you're a small property, you click on this delete icon here, confirm, and that's it. Your concierge cost type will be deleted. I'm not going to input data for every single type of employee here. I'm going to just do it for few employees so that you see how it works in Modelix. But you can continue when you're creating your own financial model for your property. You can fill out all the types of employees. So let's start with receptionists. How many receptionists do we need? Let's say we have three receptionists that work on the front desk. And then the second assumption is, what is the employee's cost, or this is the gross salary that we pay per receptionist. And let's say that this is $4,000 per receptionist per month. And on annual basis, that's $48,000 per receptionist. And with that, we've defined the employee cost for receptionists. Housekeepers. And let's say we have 3 housekeepers. The employee number is 3 housekeepers. This might change during the peak months. So let's say during the peak months, we'll need 5 housekeepers. And then what is the employee cost? We pay, say, $3,000 on average for a housekeeper. With that, we've calculated the cost for housekeepers. And so on, we continue. Number of chefs and their salaries, cooks, waiters, sales managers that we have, marketing managers, and so on. Again, if you're a small property, just delete some of these types of employees that you don't have within your property. That's it. As we enter the number of employees and their gross salary, our total employee cost would be calculated. Next, we go into expenses. Now, most hotels would have these types of expenses. Again, if you are a larger property, you might have additional expenses, so you can easily add any additional expense that you have in your property, or if you want your plan to be more granular than what the Modelix template offers. So, marketing expenses. Let's start from there. Marketing expenses, you could either enter them as a budget of how much you plan to spend. Let's say we plan to spend about $2,000 for marketing during the first 3 months of the year, and then we will ramp up our marketing costs before the season. Let's say this is going to be $6,000 per month, and then going back again to during the winter months, we go back to, let's say, $2,000. That's per month, and then for the following years, let's say we are at about $50,000 marketing cost per year. Those are our marketing expenses. You can also set them up if you want as a percentage of revenue. You can easily do that. You create an expense, let's say marketing 2. It's a sales and marketing type, and then you can choose here. But if you want to set your marketing or any type of expense as a percentage of revenue, so you can also say marketing cost as a percentage of total revenue. Go next, and we'll say about, let's say, 10% of our revenue is going to go into marketing. Close. And that is, again, our different way of calculating our marketing costs within Modelix. Sales expenses. Again, similar as marketing, you can either enter the number of or the value of the sales expenses per month and per year, or you can just calculate them as a percentage of revenue. So let's say that about $4,000 per month is our cost for our cost for sales related expenses. Decorations. So we pay $1,000 per month for decorations. These are flowers or any other decorations that we have within our property. And those are the sales and marketing expenses. Then general and admin expenses, rent and property taxes, whatever we are paying for our property. Let's say that we pay about $4,000 or $5,000 per month for renting our property. Utilities, what are we paying for utilities? It's about $1,000 or $2,000 per month. If we expect any increases, we can always input the number of increase the number over time, or if we want to use a percentage growth rate, we can do that as well. You just go onto utilities, click on this edit button, go next. Here there's a button which says percent growth. So if we click that button, you'll need to input when are we going to start generating these costs, utilities. Let's say from the first month of operations is going to be 2,000, and let's imagine that is going to be 2,000. That's not going to change until April, until June. Then once we go into busy season, we expect this to increase by 100%. August will not increase at all because now it's already increased. And then we will reduce it again by minus 50% and 0 and 0. So here automatically our cost per month is automatically calculated. 30,000 and then 30,000 for the rest of the years. Click save and close. With that, we've calculated our utilities and so on. Let me not go through all of the expenses for this demo, but in a similar fashion, you would calculate all the different expenses for your hotel. Next, we'll go into assets. Now, assets are the assets that we have in order to run our business. And in a hotel, usually you have your property assets, you have your furniture, you might have some vehicles. Now, when it comes to property, we said we are renting this property. So in terms of property, what we would have is as an asset any refurbishments that we would have to do in order to bring the asset into a state that we want it to be for operations. So let's say in the first month of our operations, we would invest about $30,000 into renovating our asset. We click save and close. But before that, we have to define what is the life of the asset, or what is the amortization period for this asset. So let's say that in about 10 years, we expect to renovate again this asset. So we'll set the life of the asset at 10 years, and we will say save and close. Now, the other type of asset, furniture. Let's imagine that our property came with furniture for hotel, but we needed to add some additional. We need to buy some additional furniture for our hotel on top of what came with the property itself. So again, we're going to go into edit, and let's say that in the first month of our operation, we're going to buy additional furniture for about $10,000. Again, the life of the asset for this for furniture. Let's say that we need to exchange it again in about 5 years from now. So we'll leave the life of asset at about 5 years. Click save and close. And now the total investment into assets that we have for furniture and for refurbishment have been calculated. Vehicles for this in the template there's also vehicles as a type of asset, but let's assume that we're not going to have any vehicles in our demo hotel. Now, what I see here is that our cash balance is negative, and of course we cannot have a negative cash balance for our business, which means that we need to raise some funds or get some funding or get a loan for our business not to have negative cash, which takes me directly into the next section of our financial plan, which is the financing. We go into financing here. Now, let's assume that we're going to put in an initial investment of our own initial investment into the hotel, which is the equity investment. This is the owner's equity. I'm going to click edit, and we're going to go next here, and let's say we're going to invest $20,000 at the beginning. And I'm going to click save and close. That's all I'm planning to invest in my hotel. Now, if I go back into assets, just to check on my cash balance, I can see again that I have a negative cash balance up until June. So the highest negative cash balance is about $42,000, which means I need at least another $42,000 financing from some other source. So let's go back into financing, and let's say that we're going to get these additional funds from a bank loan. There's a bank loan here in the template. I'm going to just click edit, and then I'm going to define that I'm going to get this loan in the first month of operation in January 2024. I'm going to take $50,000 of a loan. I'm going to pay back this loan in let's say 60 months, and I'm going to pay a 5% or 6% interest rate. There will be no grace period, and I'm going to pay back the loan on a monthly basis. With just those few inputs, we click save and close, and now all the cash flows related to this loan, meaning the receiving the loan and then all the repayments of the loan, have been automatically calculated for us. Let's go just back into assets, just check at our cash balance. Looks like our cash balance is positive everywhere, so we are okay when it comes to funding. Next is our taxes. Most countries, you would have income tax, and you would have an income tax type of tax, and then in different countries you would have either a sales tax, this is for the US, or you have VAT in most other parts of the world. Now, usually when you plan, you would just plan for the income tax, but and let's go into and edit this income tax here in Modex. We click edit, and the only assumption that we need to put in is the income tax rate. And let's say that we pay about 15%. Our tax rate in our country is about 15% of our profits. We're going to pay into income tax. We click save and close, and our income tax has been calculated. Now, if we want to add an additional type of tax, which is, as I mentioned, you can either have a sales tax for the US or VAT, or VAT for most other parts of the world, you can add it here. But for this example, I'm not going to add any additional tax. And finally, working capital assumptions. This helps us calculate the working capital that we have in our business, just to make sure again that we don't need additional funding because of working capital requirements. In order to calculate the working capital, there are three specific parts of working capital. There's the accounts receivable, or this is the amount of money that customers will owe to us. The inventory, if we have any inventory, in our business, and then the accounts payable, or this is the amount of money at each point of time that we owe to our vendors. Now, to calculate the accounts receivable, we're going to go into a little bit more detail here. I'm going to click on the enter detailed assumptions, and we're going to enter assumptions on a revenue stream level. So for the room revenue, we expect that most of our customers, or all of our customers, let's say that 100% of our customers are going to pay us at the time when they stay at the hotel. So literally, we're not going to give any payment terms to our customers when it comes to room revenue. So we will say that 100% of our customers will get 0 days to pay for their stay in our hotel. Food and beverage revenue, same thing. 100% of our customers are going to pay right away when they eat. So there's not going to be any payment terms for our for our customers that dine into our restaurant. For different types of businesses, this is more specific to the restaurant business. But for different types of businesses, you might be issuing invoices with payment terms, and then you would say that, let's say, 100% of your sales are going to be paid at an invoice with payment terms of, let's say, 30 days. But for our hotel revenue, is a small hotel, we're going to stick to the assumptions that all the revenues are going to get paid at the time when the customer stays in the hotel. No payment terms. Inventory. Again, I'm going to click on the detailed assumptions. So in order to calculate the amount of inventory that we need to hold, we need to just define one assumption. That is the number of inventory days that we hold inventory in our stock. So housekeeping supplies, let's say that we have about, at any point of time, we want to hold about 30 days of housekeeping supplies in inventory. F&B inventory, let's say that we want to keep about 10 days of inventory for our restaurant. Commissions, there's no inventory when it comes to commissions. Credit card processing fees, again, there's no inventory there. And then guest amenities, let's say that we want to hold about 10 days or 20 days of guest amenities into inventory. And finally, accounts payable. This again, I'm going to click on the enter detail assumptions so that we can define our accounts payable on a cost by cost line. Now, housekeeping supplies, when we buy them, let's say we buy 100% of our housekeeping supplies and we pay 30 days later. F&B costs, we buy 100% on credit terms and we pay, let's say, 15 days later. Commissions, again, commissions we don't, we pay them, let's say we actually commissions to Booking.com, let's say we pay at the end of each month. So let's say we pay 100% of our commissions 15 days later. Credit card processing fees, again, 100% at the end of the month. So 15 days later on average, and so on. We can just define for every type of cost, what are the payment terms, what percent of that cost is getting paid on payment terms into the future, or what percent of the purchases are paid and how many days after they're invoiced to us. And that's it. We have defined the final assumptions, which are the working capital assumptions for our hotel. We're now ready to look at our reports and see how our hotel is doing. Now, the report section, three most important financial statements. There's your profit and loss plan, your balance sheet, and your cash flow statement. Let's start with the profit and loss. This is usually the most important financial statement from your plan. So let's look at it on a monthly level. First, what we see here is that we are generating about $40,000 of revenue in the winter months, and then it goes up to almost $200,000 in the peak season in the summer months. And then again, towards the end of the year, it goes down. On an annual basis, we're generating about $1 million or $957,000 in the first year, $1.3 million in the second year, and $1.3 million in the third year. As we go down, we look at our gross profit and our gross profit margin. We see on annual basis that we're somewhere around 82% gross profit margin, which is quite a healthy gross profit margin for a hotel. We have all our operating expenses here, and we see that our EBITDA margin is somewhere in the range of first year 22%, then it goes up to 40% almost in the last year. 40% EBITDA margin is not the greatest EBITDA margin for a hotel business, but it is decent enough. And as we go down, all the way down to net income, we can see that we are generating about 18% net income margin in the first year, and then 33% in the last year. The other thing that we can see from profitability perspective is that during the slow months, during the winter months of our business, we are actually we're generating losses. For our business is generating losses. So here in the first 3 months of the year, we're generating losses, and in the last 3 months of the year, we're generating losses. However, during the peak season, the 6 months of a peak season within our business, we are able to generate enough profit to cover for those losses. Now, we can ask ourselves whether potentially we want to close our business during the slow season, and that's a decision we would have to make by ourselves, or we want to keep it open for the whole year, even though it is making losses in the winter months. So that is what our profit and loss statement financial plan tells us. Now let's look at our balance sheet. If we look at our balance sheet, I'm going to look at it on annual level. We see that that our cash balance is positive. We don't have any issues there. That's the inventory that we need, and then that's the total property, plant, and equipment assets that we need to invest in order to that we decided we were going to invest in order to run our business. In terms of liabilities, we have accounts payable. This is the money we owe to our suppliers, and income tax payable. Everything seems like that's the bank loan that we took, 50,000 in the first year. Then as it's getting paid off, that value of that loan is getting reduced. 20,000 is the shareholder equity that we invested in our business, and the retained earnings are the profits, the cumulative profits that we have generated over time. Altogether, our balance sheet looks pretty good for our business. And finally, let's look at our cash flow statement and see what it tells us. If we look at an annual level, we can see that that we are cash flow positive in every year, starting from the first year. We see here that we will need $40,000 for ask purchases that we defined, and that we are investing $20,000 into our equity of the business, our own investment. And if I open the monthly view, then I can see that we're also taking $50,000 of a loan, and it gets reduced over time as we pay off that loan. We see that in some of our winter months we are cash flow negative. Again, this kind of corresponds with the profitability of the business that we had negative profitability in the winter months. However, we are always cash flow positive, and on annual basis we are generating cash with this business. So cash flow statement looks pretty good as well. And with that, I think I will be happy with this hotel business, and I am done with my financial plan. It was as simple as that. I hope this was helpful for you. Don't wait. Jump into Modlix, create your financial plan for your hotel or your rental business within the next couple of hours. And also, if you like this video, please do subscribe to the Modlix YouTube channel. We are publishing similar videos around financial planning and financial reporting on regular basis. Have a great day. Bye bye.